Hello students, let us move on to a new concept, stock market terminologies. Each and every investor or a beginner must have a knowledge about the common terms which is used in the stock market. There are various terminologies continuously being used in a stock market. Without the knowledge of these terminologies, it is difficult to trade in a stock market. Hence, there are various types of terminologies to be known by every investor before going to invest in a stock market. Common trading terminologies. There are various trading terminologies such as arbitrage, balance sheet, basis, hedge, bear, benchmark, beta, bid and ask, broker, brokerage, long and short, buoyancy, bull, counterparty risk, listed company, margin, over the counter, volatility, stock market indices. These are the common trading terminologies which is being used in a stock market. Now let us discuss one by one. First one is arbitrage. What is arbitrage? Arbitrage consists of purchasing a commodity or security in one market for immediate sale in another market, which attempts to buy a relatively underpriced item and sell a similar relatively overpriced item, expecting to profit when the prices resume more. For example, in market A, the security value is 10 rupees, but in the market B, the security value is 12 rupees. What here the speculators do in the sense they will buy the shares or the securities where the price is very less. In the market A, the price is very less. So they'll purchase the security. The same security is valued for 12 rupees in a market B. So they are going to sell the security in a market B. So that is what the arbitrage means. Arbitrage is nothing but they'll purchase the shares at very low in a one market and the same they are going to sell for a high price in the another market in the motive to earn a profit. So that is what meant by arbitrage. Next one is balance sheet. It is an important term or important terminology each and every investor must know because balance sheet it is the one which gives a snapshot to every investor before going to invest in a stock market. It is an accounting statement or financial statement of a company's assets and liabilities provided for the benefit of shareholders and regulators. No investors will come forward without knowing the background of a company to invest in a stock market. In order to know about the company's profitability position, this balance sheet helps the investors to know the condition of a company by knowing the balance sheet. By seeing the balance sheet, they'll come to know the profitability position of a company. If the profitability position of a company is good, then automatically the investors will come forward to invest in a stock market. Balance sheet is a financial statement comprises of assets and liabilities which discloses the financial position of a company. By using this as an document, the investors will come to know the financial position, then they'll make an investment in a stock market. That is what meant by balance sheet. Next one is basis. Basis is defined as the cash price or spot price minus its futures price for the contract. It is nothing but a difference between a cash price as well as a future price. It is important because changes in the relationship between cash and futures prices affects the values of using futures as a hedge. So basis is a differences between a cash price and a future price. That is one important point for a basis. Basis, it is nothing but the difference between a cash price as well as future price. The difference is treated as an basis. Next one is hedge. Hedge, it is nothing but providing a security for our investment. What is hedge? Providing security for an investment, an asset, liability, or financial commitment that protect against adverse changes in the value of our cash flows from another investment or liability. Hedge, we can simply say that providing an or protecting or providing an security for our investment, that is known as hedge. Next one is bear. By seeing this picture, you'll come to know that the down. See, bear, he is an speculator. He is a market operator who expects the market price of shares to decline. He will be waiting to to see the decline of a market shares. Then he will going to buy that prices at a lower price. He will be going to buy the shares at a lower price. The term bear is also refers to the one who has sold shares which he does not possess in the hope of buying them back at a lower price when the market prices of the shares come down in the near future. Bear basically is a speculator. He'll be expecting to buy the shares at a lower price. So that is what a bear. Bear, it is nothing but a low market, we can tell. Next one is benchmark. Benchmark, it is a security used as the basis for interest rate calculations and for pricing other securities. It also denotes the most heavily traded and liquid security of a particular class. What is this liquid security in the sense? The security which can be converted immediately into cash. The security which bears to convert it into an immediate cash, that is known as liquid security. Here benchmark, it is nothing but it is an security used as the basis for interest rate calculations. It is an standard measure used to calculate the value of our investment, that is known as benchmark. Next one is beta. What is beta? It is a measure of the volatility of a stock relative to the market index in which the stock is included. It is the measure of the volatility, means rise or decrease in the prices of the securities. A low beta indicates relatively low risk, and also simultaneously it gives a low rate of returns. A high beta indicates a high risk, and in the similar way, in the same way, it be giving a high rate of profit. So we can tell that low risk, low profit, high risk, high profit. Next one is bid and ask. Bid, the price you can sell at. Simply we can tell that bid means the price you can sell at. Ask. Ask means the price you can buy at. Bid and ask. The difference between bid and ask in the ask means bid, the price you can sell at. The securities price which you can sell at. Ask means the securities price which you can buy. That is what the major difference of a bid and ask. Next one is spread. What is spread? It is the difference between a bid and ask. The amount, for example, the first share value is 100 in case of bid. In case of ask is 110. The difference 10 is treated as spread. In the spread, in large cap stocks are more liquid. In large cap stocks, spread will be more liquid. More liquid in the sense, as I said previous itself, liquid in the sense immediately availability of cash. The shares or a securities or a stocks which can be converted into cash immediately, that we know, that is known as liquid. Small cap stocks are less liquid. Yes, large cap stocks are more liquid, but small cap stocks are less liquid. Next one, broker. Who is a broker? A broker is a member of a stock exchange. In order to become a member, he need to register in a stock exchange who acts as an agent for clients and buys and sells shares on their behalf in the market, stock market. So, what is the main function of a broker in the sense to perform the function on behalf of his clients? That is what a major work of a broker. He is a broker, registered broker. Only if he registered in a stock market, then he'll become a member of a stock exchange. The performance of his part of the contract both in the market and with the client. He is deemed as a principal, a peculiar position of dual responsibility. He even acts as a principal also. So here broker is nothing but an agent who performs the activities on behalf of his client. What is the activities? That is buying and selling of shares in the stock market. Next one is brokerage. Brokerage, it is nothing but an commission which is paid to a broker for the performance, for the function undertaken on the behalf of his client. So commission payable to the stockbroker for arranging the sale or purchase of securities. The scale of brokerage is officially fixed by the stock exchange. The amount of commission to be paid to a broker, the amount that is the scale, it is fixed by a stock exchange. So here this is what a broker and brokerage means. Next one is long and short. What is this long and short? It is a trade direction. Trade direction means if you will be telling my securities is of a long and my securities is of a short. So what is this long? Long in the sense profit if prices goes up, in the sense the securities which is holding by an a shareholder or an investor, the it is bearing a profit means its prices will going up. So that the word long is indicated for a trade direction for a particular securities. So short is opposite to one long. It is also profit if prices goes down. So here in long the prices will be going up, but in short prices will goes down. So that is what a difference is between a long and short. Both are providing a profit, but the profit is going up, but here profit is decreasing. That is what meant by short. Next one is buoyancy. The word will be you while watching news and all, we will be hearing the word buoyancy. What is this buoyancy? Buoyancy it is nothing but a rising trend in prices of a securities. A rising trend. The increase of a prices day by day. What is the prices increasing of for a securities? So for that they are using the term as buoyancy. Next one is bull. He is an opposite to a bear. So bear he will be waiting to purchase a securities when it is value is decreased. Here bull he is always he is also an speculator where he will be looking forward to sell the securities at a high price. He is a market player who believes prices will rise and would therefore purchase a financial instrument with a view to selling it at a higher price. He will be thinking to sell a security at a higher price. But in case of a bear, he will be looking forward to purchase a securities at a low price. So this is what a major differences between a bull and bear. Next one is clearing house. As the name itself indicating a clearing house in the sense the settlement. So it is a department of an exchange or a separate legal entity that provides a range of service related to clearance and settlement of trades, and the management of risk associated with the resulting of a contract. Clearing it is nothing but it is an house or it is a department, it is an entity where it makes a settlement procedure in between a clients or for a contract. That is what known as clearing house. Next one, counterparty risk. What do you mean by counterparty risk? Counterparty risk in the sense, if any of the party in a contract fail to undertake his proceedings, then the risk is arised. That is known as counterparty risk. See, the risk that between the time of transactions has been arranged and the time of actual settlement, the counterparty to the transaction will fail to make the appropriate payment. Counterparty risk in the sense, any of the party in the contract at the time of settlement, if it does not make a proper payment, then the risk arises. That is known as counterparty risk. Next one is listed company. Yes, listed company means it is a company which is listed their securities or shares in a stock market owned in a recognized stock exchange. Only those securities have a value where the investors can go and invest in those securities. Without the company listed, no company cannot sell their shares in a stock market. Before selling their shares, before that they must make a list in a they must register in a stock market. See, that is what they are telling. A company which has any of its securities offered through an offer document listed on a recognized stock exchange and also includes public sector undertakings whose securities are listed on a recognized stock exchange. They must, before selling their shares to a general public, before that firstly they must list the or they must register their shares in a recognized stock exchange. Then after only they are able to sell their securities to a general public. Securities, it can be a shares or debentures. That is what a listed companies. Example, Infosys, Wipro, TCS. These are the various companies, top leading companies which are registered or which are listed their shares in a stock market. Next one is margin. Margin. It is an advance payment of a portion of the value of a stock transaction. The amount of credit a broker or lender extend to a customer for stock purchase. It is a margin, it is nothing but an advance payment. Advance payment which is made in the process of a transaction. That is what known as margin. They will be telling margin fixation. It is nothing but an before that we need to make an advance payment. That is what meant by margin. Next is over the counter. So over the counter means a financial transaction that is not made on an organized exchange. Generally, the parties must negotiate all the details of each transactions or agree to use simplifying market conventions. Over the counter market means the agreement or a proceedings of a proceedings of a contract is being taken with the mutual consent of both the parties. So hence we'll call it is an unorganized exchange over the counter market. It is a financial transaction. It is not made in an organized exchange. In the sense, it is an unorganized sector where both the parties come with the mutual consent of exchanging the contract with each other. That is what over the counter market means. Next one is volatility. We will be hearing the volatility in the stock market, volatility in the price. So, what is this volatility? It is basically defined as the rate at which the price of a securities increase or decreases for a given set of returns. It indicates the risk associated with the changing price of the securities. So volatility, it is nothing but a risk associated with changing price. We know that stock market is not a stable. Day by day the price fluctuations is happening due to some other reason. Either it may be due to an economic condition. So all these factors been considered to the price fluctuations in the stock market. So price fluctuations will be taken place in a stock market. Hence we tell that it is not a stable. So volatility means it is nothing but an changes in a price which indicates the risk associated with the changing price of the security. That is what meant by volatility. Next one and last one, stock market indices. What is this stock market indices? It is a stock market index. It is a statistical measure which shows changes taking place in the stock market. It is nothing but a measure which shows the changes taking place in the stock market. To create an index, a few similar kinds of stocks are chosen from amongst the securities already listed on the exchange and grouped together. So stock market indices, it is nothing but it is an statistical measure or a standard measure which shows the changes taking place in the stock market. In order to show the changes, they'll group the similar type of stocks and check, and they will see the changes which has happened to a similar stocks. So that changes they'll bring out by using this measure. That is what known as stock market indices. So these are the various different stock market terminologies, common terminologies where day by day in a stock market they are using. Before going to be invest in a stock market, each and every investor or a beginner must know these basic terminologies. Then if we don't have any, if the investor does not have a knowledge regarding the terms used in a stock market, then it is difficult to trade in a stock market. Without knowing the terminologies, if you're going to invest in a market, sometimes he might lose or sometimes he will incur a loss. So if we know the exact meaning of what is volatility, what is benchmark, what is bull, who is a bear, if we know these certain common terminologies, then it will help to an investor to make an investment easy. These are the various stock market terminologies used in a stock market. Hope you are all understood the previous concepts, that is stock market terminology, history of stock market, and the which is included in a capital market, that is scam of 1992. In 2001, that is Harshad Mehta scam, and types of companies which are listed in the stock market, and types of stocks based on stock market. So these are the four concepts which I have been explained. Hope everyone understood. Thank you. Have a good day.